If the Canadian economy does indeed move into a recession, is your portfolio ready? Hold on to your seatbelts, folks. This is going to be a good one. Canada is at a pretty serious juncture in our economy, without a doubt. We have a trade war with the United States and the potential fallout, which will more than likely sink our economy into a recession. As investors, this is absolutely very concerning, and many are choosing to switch to a more defensive investing style. When markets are doing well, investors often chase growth and take profits as stocks are growing. However, when a recession comes along, the focus can shift to overall stability. A steady stream of income in the form of reliable dividends with consistent payouts can be a financial lifeline during those tough economic times. This is because economic stressors like capital gains they're more unpredictable as markets swing wildly, and of course job security may even come into question. That's exactly when passive income can save the day, providing financial stability, peace of mind, and of course consistent cash flow. Dividend growth investments, particularly dividend focused ETFs, not only help maintain your purchasing power when inflation and market volatility rise, but they also let you continue reinvesting those dividends to feed the overall snowball. Stability also means reducing stress. Knowing you have predictable income coming in each month, that allows you to focus less on market anxiety and more on long-term wealth building. Ultimately, this is going to protect your portfolio and your peace of mind at the same time. A sub to the channel adds some stability to your flow of future content. For today's list, I am looking for 5 dividend growth ETFs that have potential to perform well as we move into a recession. Do keep in mind, though, performing well in a bad market is not always in the green, but sometimes it can be. There are definitely some bangers on this list that may drift more into the green as we move through the rougher times. Whether or not these ETFs stay in the green in the next recession, they all do have that potential to rebound really fast once we get on the other side. Today's list, as usual, was sorted by their 1-year total return. So, without any further ado, let's do this. We will kick off this list with the Global X Equal Weight Canadian Pipelines Index ETF. They have a ticker of PPLN. This ETF focuses on midstream Canadian oil and gas companies, allowing investors to participate in the transportation and distribution aspects of the oil and gas industry, which are vital for connecting upstream production with downstream refineries and distributors. At the time of recording, their price was coming in at $11.55, and they have an NAV of $11.50. Their assets under management coming in at $32.67 million. Looking at their fees, they have a management fee of 0.25%, and their management expense ratio, that's coming in at 0.74%. In regards to dividends, they have a yield of 4.75%. It is a quarterly dividend of 4.5 cents per share. Looking at returns, they have a 3-year return on investment of 23.13%. Factor in the dividends, we get a total return of 33.61%. On their 1 year, the return on investment a little bit lower, 4.71%. Add the dividends in, total return 7.82%. On the 3-year annualized, they're coming in at 10.14%. The top 5 holdings for PPLN are Southbow Corporations, Pembina Pipelines, Keyera Corporation, TC Energy Corp, and, well, of course, Enbridge. With a focus to improve our energy infrastructure, this ETF may just turn into a real superstar for sure. In our number 4 position, we have the BMO Canadian Dividend ETF with a ticker of ZDV. This ETF provides a yield-weighted exposure to Canadian dividend-paying stocks. At the time of recording, their price was coming in at $22.50, and they have an NAV of $22.49. Those assets under management, $1.12 billion. Their management fee coming in at 0.35%. Management expense ratio, 0.39%. Their dividend yield, that's coming in at 3.446%. It is a monthly dividend of 7 cents per share. Looking at their 3-year return on investment, that comes in at 4.02%. Factor in the dividends, total return 15.03%. On their 1 year, that return on investment comes in at 11.50%. Adding in the dividends, we get a total return of 15.66%. Their 3-year annualized, that's coming in at 4.78%. Okay, the top 5 holdings for ZDV, well, we got TD Bank, Enbridge, Royal Bank, Canadian Natural Resources, and BMO. The Bank of Montreal does a good job of managing their ETFs, and this one should keep the dividends flowing. And sometimes when everything else is hitting the fan, dividends can definitely be a spark of positivity for sure. All right, in our number 3 spot, we have the iShares S&P TSX Canadian Dividend Aristocrats Index ETF. They have a ticker of CDZ. This ETF tracks those wonderful, those very wonderful dividend aristocrats. Of course, those are those companies that have increased their dividends for at least 5 years in a row. At the time of recording, this ETF was coming in at $35.43, and they have an NAV of $35.41. Assets under management, $918.76 million. Looking at the fees, we get a management fee of 0.60%, management expense ratio 0.66%. Now, speaking of dividends, they do have a yield of 3.447%. That is a monthly dividend of 11.2 cents per share. On their returns, 3-year return on investment 6.36%. Factor in the dividends, total return 17.36%. On their 1-year return on investment, 12.26%. Adding in their dividends, we get a total return of 16.45%. 3-year annualized, that is coming in at 5.48%. The top 5 holdings for CDZ are BCE, Allied Properties REIT, South Bow Corporation, and TELUS. I do love dividend aristocrats, and these are the companies that will not only preserve their dividend through a recession, but increase those dividends as well. So that's not too shabby. Coming in at our almost top spot at number 2, we have the Vanguard FTSE Canadian High Dividend Yield Index ETF with a ticker of VDY. This ETF is designed to track the performance of the FTSE Canada High Dividend Yield Index, providing investors with exposure to Canadian companies characterized by high dividend yields. At the time of recording, their price was coming in at $49.27, and they do have an NAV of $49.24. Those assets under management of $3.47 billion. Looking at their fees, love these. They're nice and low. Management fee 0.20%, management expense ratio 0.22%. When it comes to their dividend, they have a yield of 4.10%. That's a monthly dividend of 21.7 cents per share. Looking at their returns, their 3-year return on investment 5.78%. Factor in the dividends, boy, this is a big jump. 21.69% total return. Looking at their 1-year return on investment, that's coming in at 12.59%. Adding in the dividends, we get a total return of 17.61%. Their 3-year annualized, that's coming in at 6.76%. The top 5 holdings for VDY are Royal Bank, TD Bank, Enbridge, BMO, and Scotiabank. This one is a community favorite for a reason, and that is that it really does very well and is without a doubt a hold forever foundation circle the wagon blue chip ETF. Okay, you guys are waiting for it. Here we go. Our number 1 spot this time goes to the iShares S&P TSX Capped Utilities Index ETF. They've got a ticker of XUT. This ETF provides some great exposure to the Canadian utility sector, and this could very well be, it could be the sector to watch through the potential recession for sure. At the time of recording, their price was coming in at $28.79, and they have an NAV of $28.81. So assets under management, $354.41 million. Looking at the fees, management fee 0.55%. Management expense ratio 0.61%. Looking at their dividends, they have a yield of 3.949%. It's a monthly dividend of 9 cents per share. Okay, on to their returns. Their 3-year return on investment, well, it's not looking great. It's coming in at negative 11.42%. Add in the dividends, total return negative 1.98%. Honestly, utilities had it rough during the aggressive rate hikes, and we're seeing that in these numbers. But if we look at that 1 year return on investment, that's coming in at 16.80%. Factor in the dividends, total return 21.41%. That's good enough to top the list. Their 3 year annualized, once again, it is in the negative 0.66%. The top 5 holdings for XUT are Fortis, Brookfield Infrastructure, Mira, Hydro One, and Alta Gas. Utilities love low rates, and they tend to do well in recessions. Don't let that negative on the 3 year fool you. This one is ready to kick it in the recession for sure. These are some great ETFs, and I do like them a lot. In fact, I just added XUT to the 0 to 100K challenge. Of course, there are a lot of good ETFs that could have made this list, and I would absolutely love to see your picks down below. If you are interested in any of the ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on Canadian utilities, and I will see you in the next video.